On this episode of Through the Pines, we'll cover your ultimate financial high-level checklist, including insurance, emergency fund, debt, estate planning, saving strategies, retirement, financial goals, and dreams. It's not a comprehensive list. However, it is a good list to make sure that you have your financial bases covered, and it's also a good order of operations. So grab a note-taking tool, a pencil, notes app, etc., and let's dive in. Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while chopping wood with his bare hands. This is Through the Pines. We welcome our guests for this week. We have Rex Baxter and Brandyn Smith from planwithbaxter.com. They are our official financial planners for this episode. They are the 2023, 2024, and 2025 Forbes Best In-State Wealth Management Teams for Utah, as well as the Advisor Hub, fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award, which means they know what they are talking about, and you can reach them anytime at planwithbaxter.com. Go to planwithbaxter.com. All right, so let's dive in. We'll tackle insurance first. Brandyn, I feel like you have a bit of a history in insurance from what I know of you. So, is that the first thing? Because you listed it first. So before you even save a dime, before you put anything in your savings or start paying off any kind of debt, we got to take care of insurance first. Is that right?
Yeah. And thanks for having us on your podcast. It's funny. You wouldn't think that originally, right?
Yeah.
You'd think, no, I need to get some money saved up in the bank, and then I need to get, but the reality is, if you, let's say you don't have your emergency fund in place and something happens and you have an emergency come up, like that can set you back a little bit. You might go into some credit card debt. Let's say you don't start saving for retirement right away. That'll set you back a little bit. But if you don't have insurances in place properly and you have a major event happen, like a catastrophic, a premature death, you have a car accident that exceeds deductibles, you have, a major going on with your house, if something like that can derail you for the rest of your life. Like to the point that you or your family might never come back from it. Mm-hmm. And so we see insurances as, and Rex and I, we're not fans of being overinsured or taking out a lot of insurance. However, it's very important that you're reviewing your insurances to make sure that it's not the most exciting, but it also can be the most immediately catastrophic more than anything else on this list.
You put these in order now. Is this the order in which you should take out insurance? You have health insurance, home and auto, life, and disability.
Yeah, frankly, all of them are really, really important, okay. Right? Like all of those can become catastrophic. Health insurance, that's one of the leading causes of bankruptcy mm-hmm. is not having health insurance in place. That's a really big one. You could be totally fine getting in an accident, and next thing you know, have hundreds of thousands of dollars of bills lined up. That's something we need to take care of. If you don't have health insurance, there's plenty of providers that won't even treat you for cancer, right? You have a preventable cancer and they won't take you on because there's no way to pay them.
Oh my gosh.
And so there's things, there are just some things, and health insurance is one of those major ones that we want to make sure we've got something in place. Now, we don't need the most expensive plan. We don't need all the bells and whistles, but we need something that would take care of us in the event of a catastrophic event.
I had this great comedic comedy the other day. There's little shorts, the shorts, and he says, like, he's talking about health insurance, and he's like, I have bronze, which you would think would be good health insurance because it's like third place in the Olympics, like,
right.
like you think that. And he's like, but he had to see a podiatrist. This is this shtick. And he calls and he tells them, I've got, bronze level and I need to see such and such doctor. And they're like, well, that doctor doesn't take bronze level. You got to see so-and-so. And he's like, wait a minute. There's like, I can't see this doctor on that insurance. I have to see I don't want to see the bronze level doctor. That doctor is not going to be a good doctor. But it doesn't matter. So, but it's a thing. It's a funny commentary on health insurance in the certain levels, but you got to have health insurance.
Yep.
Yeah. Well, and on top of that, you have, like, on a bronze level, you have an enormous deductible, right? And
right.
You still might have a 10 or 15,000. And so there's the company is still worried, am I going to get paid still for this medical procedure, whatever it is.
Mm-hmm.
because he's only a bronze guy, and so all of a sudden you're getting discriminated against because you're bronze.
Right. Yeah.
But we can overcome that.
Yeah,
Right.
we
Like
can.
we can over if all of a sudden we have a $15,000 debt placed on a financial plan, very few plans we can't work through that. If we have a $500,000 expense, a medical bill placed on a plan, that maybe not.
Right. We might not be able to recover from that. It's either bankruptcy or depending upon what the issue is. You may even, if it's a disability issue and it's $500,000 in medical expenses, and now you're disabled and you don't have disability insurance, now all of a sudden you've lost your power to grow your income and to produce an income. And so, not only did you, sacrifice the financial future of your wife and your family, but also all the way up throughout. I mean, it's just going to, put a big anchor around your ankle.
Around your finances, maybe?
Around your finances.
Yeah. Okay. So health insurance first, number one. And we should have all these, but that one's probably the most important. And then home and auto insurance, Brandon.
Yeah, that's a big one. Especially, we're recording this in Utah. The state minimums in Utah are very, very low. Which means
for home and auto?
For auto.
Oh,
and what that means is if you go to your auto insurance and say, hey, just get me the cheapest thing, I need it legally, right? Just get me the cheapest thing possible, the cheapest coverage possible. What you're going to find is that your limits are very low. And so if you get in an accident, you might injure someone or you might damage their vehicle. And then you're like, well, here's my insurance. Your insurance comes back and says, yeah, we'll pay the $25,000 or we'll pay, whatever that minimum amount is. But then beyond that, you're liable.
Yeah.
Right. And some people might say, well, I don't have any wealth yet. I don't, come sue me for it. Right. And that's one way to look at it. But then the downside is you've hurt someone and they don't have a way, a way to be made whole unless they have, an uninsured motorist, which is a good idea. Right. But still, it's one of those things where, all right, we want to make sure that if we accidentally hurt someone else, that they can be made whole.
Yeah, I didn't understand this when I was 16 because you're 16 and you
Yeah.
don't understand these things.
Right.
And I bought my first car. I paid like $300 for it, and they're like, "Well, you need liability." I'm like, "I don't need insurance. I paid $300 for this car. Like,
Right.
why do I need
Right.
insurance for this thing?" But it's not for me and my car. It's in case I hurt somebody
Someone
else or
else.
you hurt
Which
someone
has a higher probability when you're
Right.
16 with
Right,
a $300 car that doesn't have brakes.
else. That's pretty true. Yeah.
You're still Flintstoning it.
Yeah. Yeah. Okay. And then life insurance. How much should we have?
Yeah, a lot of rules of thumb on that, and really it comes down to what you would want to have happen if you were to pass away. And so that's something we have these conversations with clients all the time. Of if you were to pass away, what do we want to provide? Do we want to pay off debt? Do we want to provide a source of income? If so, how long? Do we want to just cover income while, kids are in school? And, and so we can talk through those. The key thing to remember about life insurance, specifically term life insurance, is it's usually fairly inexpensive, especially if you don't have too many major medical issues. You can get coverage, $1 million for very minimal amount. I mean, depending on your age, right? You're looking at $30 to $100 a month, depending on health and age, and it can vary around that. But by and large, right, it is just not very expensive to make sure that your family's taken care of if you were to pass away.
Okay.
It's interesting on life insurance how often people would come to us and as we look at their life insurance, it tends to lean on kind of one of two camps. One is I'm insured through my employer. Right. And typically that's 1 times your salary, or sometimes you can buy additional insurance through your employer to where it's 3 or 5 times your salary is what that comes out to. And yet they haven't really done the work to figure out what is the appropriate amount of insurance that we need and what are the goals I'm trying to insure for. Am I trying to insure, my kids through college? Am I trying to insure, my wife through the rest of her life? Am I trying to provide some lavish lifestyle? What am I trying to insure for? And so that's typically one camp. The other camp that I see a lot is people have bought some sort of policy, or their parents had bought some sort of policy that's in force since they were, 20 or 25 or 15 or something like that. And they've never gone back and really re-looked at it. They've just like, oh yeah, I own this policy. Well, how does it fit in with all your other policies? Or do you have any other policies? And most of the time they don't have any other policies.
And who's the beneficiary?
And
that changed?
That's
Yeah.
important. Yeah.
Right. Right. And is it going to implode? Or are you making, premium payments still on it? Or are you not? And so understanding what you have versus what your goals are and trying to marry those two is extremely important. Probably more important than to get right than any of the other financial matters, to make sure that the health insurance, the property and casualty, which is your home and auto, as well as your disability and your life insurance, to make sure that all of those boxes are checked first, and just make sure that that's taken care of.
Okay.
And that the need for life insurance changes over time. Usually we see that going down. So when you're younger, you need a lot more because you usually have more of a mortgage, a young family, things like that. And then as you progress towards retirement, a lot of times that need for life insurance goes down. A lot of times it goes away completely, depending on how much we've been able to build in wealth.
Okay. Rex, you touched on disability. You want anything else on disability?
Yeah, I would say that this is probably one of the most underused insurance of those insurances that we've listed, that people are typically paying the least amount of attention to. And yet it's probably one of the most used, other than health insurance, which is used a lot, and property and casualty, right? But between life and disability, more people would probably use disability than life.
Yeah. In fact, I've got some stats on that. This comes from the Social Security Administration, but they did a study, and what they said, and this is actually from 2025, they said for an insured worker who attains age 20 in 2025, the probability of becoming disabled between age 20 and normal age retirement, which is 67, is 24%.
Oh.
They have a close to 1 in 4 chance of needing disability between age 20 and 67.
Well, that's why we don't have a fourth on the podcast.
Stop. Yeah.
They go on to say the probability of dying between age 20 and normal retirement age is 13%. So about half that. And what we find when we meet with people is most times people have heard of life insurance. Now, is it in order? Is it correct? Is it, as efficient as possible? Maybe not, but they've heard of it and they've usually done some of it. Disability, unless the business offers it, a lot of times people haven't done disability insurance.
Yeah, that's my question. I have a couple friends who collect disability from the military. And so they probably, when they sign all the paperwork, I mean, I'm sure maybe they knew, maybe I don't know, but they got disability insurance, whether they knew they were going to get it or not. And sometimes with your work, you can get it if something happens, but you don't ever usually ask until something happens. You're like, oh, well, do I have I don't know. I hope I have disability,
Right.
So, but what you're saying is you can go shop for disability insurance outside of your employer.
Yeah, you can go out. So the U.S. Bureau of Labor Statistics estimates that about 34% of private industry workers have access to long-term disability insurance.
Okay.
So 34%.
Meaning 65 don't.
Right.
That's a lot.
A lot of people.
Yeah.
What we usually find is that the group policies are usually a lot less expensive. And so we usually encourage people to start there, right? And get that. And let's look at the policy, see what it covers. And then perhaps get a supplemental policy on top of that. Or if you're not offered anything at all, then maybe we look at a separate policy altogether.
Well, yeah. What about me? I'm self-insured. I'm entrepreneur, solopreneur, whatever. What about people like that?
Yeah. So I think somebody that is, self-employed or an entrepreneur and just starting out, I think it's extremely important to still have a disability policy in place. You can go and do it privately on a private insurance policy, and looking at what the income is that you're making now, and typically they'll insure up to about 60 to 65%, 66% of your income is typically what they'll insure up to, and typically there's a cap there. And so we run into kind of two different situations frequently. One is to where it is somebody that's self-employed and they don't have disability insurance. And so we need to look at that. And again, 65% of the working population does not have access to company-sponsored disability insurance. So that's a lot of people that don't have disability insurance and are just kind of rolling the dice for 1 out of 4 that's going to end up on disability, right? That's a big number.
Yeah.
So that's one of the issues. The other is that most company-sponsored disability policies, and we work with a lot of these types of clients, but they cap out at some level. They cap out at $10,000 a month benefit or $15,000 monthly benefit.
Got you.
And we have some higher income clients that may be making, $30,000 a month, $50,000 a month, $70,000, $100,000 a month. And their disability policy only covers up to 15, and all the listeners are going, "Oh, poor them." But the reality is,
But that's a big difference.
that's a
when you
huge
have-
difference for them and their family.
Yeah.
Well, and you have
yeah.
a mortgage. You usually, you've committed to quite a few things financially, and so will you survive? Sure, but it completely derails everything you've been building.
And is it geographical? Because we were talking about living in LA before the podcast started, and what it costs to live there versus living in Utah. And it's like, if they don't change depending on where you live, then it's really a problem.
Yeah, then it's a major problem. If it's a company that might be, centered in Utah or Colorado, and they have employees in LA, and they're treating some smaller cap on the employer-sponsored benefits to keep the benefit cost down to the employer, you really need to look at those policies. And so you might find an employer that took on a policy to say that they have a policy, but they aren't trying to put very much company money into it. And so your limits may be really low, or the definition of disability may be extremely narrow to where, you've got to, it may not match with the Social Security's definition of disability. And so, you really want to dig into those policies.
Okay.
Yeah, most people think disability is going to be, a bike accident or skiing accident or a car accident, but the reality is most of it's other stuff like musculoskeletal, back pain, joint pain. It's mental health conditions fall under that category. It's cancer, heart disease, stroke, pregnancy complications. Right, those are some of the major things that we see that you become disabled for. And it might not be for the rest of your life, but it might be 5 years while you fight cancer. And during those 5 years, what happens if your income just turns off? And so I think, again, high level, some people are easier to insure than others. For example, an accountant, right? An accountant's so easy to insure. He could roll in a wheelchair and still be able to do most of his daily tasks, right? And still earn an income, still have, and so an accountant's a lot less expensive to insure than someone that's maybe working construction that needs to have full functionality, and back pain can literally disable them. And so it's good to consider that if you're someone that is in kind of like an office job, chances are you can probably get some pretty affordable disability insurance and just cover your family just in case, something crazy happens.
All right. So on the ultimate financial checklist, number one, insurance. And we covered the different areas there, segments that you should have covered. Health, home, on auto, life insurance, and disability. Next on the checklist is emergency fund. Okay. So that's the first thing we put our money into is an emergency fund, Rex. How much do we need?
3 to 6 months typically of your spending. Of your required spending. So that's not necessarily of your gross income.
All right, I have a question. I've wanted to ask this for a long time. That 3 to 6 is always the answer. 3 to 6 months.
Yeah.
Why are we doing 3? Why don't we just do 6? I mean, 3 is like why 4?
These are
Why did we come up with 3 to 6?
Great questions.
Yeah.
Why do you get your driver's license at 16?
Right.
No,
yeah.
No, I'm just kidding. It's because I said so. No, no. The reason that we have the ranges is because of the stability of your income. Is typically the more stable your income is, then typically the less we have to keep that liquid and that accessible. And so if we're on the 3 month short end, something like that, or 4 months, something like that, then that other 3 months ought to be invested. We still want it somewhere. It just doesn't need to be readily accessible within 24 to 48 hours.
Okay, Brandon.
Yeah. Emergency funds just are inherently less productive. And so less productive, meaning your interest earned on that money is a lot less. And so we want to stay as lean as possible while still covering the need. And so a couple of other things, on the 3 to 6 month range, if you're a single household family, then maybe you want to have more just because if something happens, then all of the income's gone. If you're a dual income family, then if one of the incomes goes away, well, your income's only cut in half, or give or take, right, depending on kind of that split. And so really stability of jobs, dual income, just and a lot of that is situational, where you sit down with someone and say, all right, what are the expenses? Where are we at? And you kind of figure it out from there.
But this is not a line of credit, right? Your emergency fund is not
That's
a line
my
of credit.
next question, Rex, is where do we house this? Is this my Coinbase account? Is this my Platinum credit card? Like where do we put our line of credit? Our line of credit.
So my personal feelings on
emergency
this
fund.
is that there should be a firewall between your daily operating, so your checking and savings. There should be a firewall between that and your emergency fund, to where you have to purposely go and request the money to get into your checking or savings account from somewhere, whether it's an external money market fund, whether it's a high yield savings at a different institution, whether it's something somewhere. But I also don't want it to be extremely volatile. And so you ask, should it be in cryptocurrency, Coinbase, or should it be in something else? If it's a volatile asset, then the answer is no. This should be a non-volatile investment. It should be something where only the interest rate is fluctuating, and so that it's safe, it's liquid, we can pull at it really quickly. But my personal preference is that firewall. You should have to go through a couple of steps in order to get it into your checking and savings.
Brandon, Rex used the word investment. Is this an investment?
Technically, yeah, absolutely.
Technically, okay. Even if the
like
rate of return is so small that you could be potentially not keeping up with the dollar or whatever.
Yeah, you might be going backwards as far as inflation and taxes are concerned. You might be going backwards on the emergency fund.
Okay.
But it's part of a holistic plan, right? We pay insurance, and hopefully I never use my life insurance.
Yeah.
But like the emergency fund is the same thing.
Okay. All right. So anything else on emergency fund? Yeah, that's pretty cut and dry.
It's an easy
3 to 6 months. Depending.
4.5.
4.5. Okay, very good. All right, what's next is debt, and that is something that I'm really good at. Used to be. I started
You're
off
a collector.
young. Well, I have a lot of. I shouldn't say I'm really good at. I started early. I started early on that, and well, I did it I did it right the first time, where you go in and you save the $300, and then you take a loan out against your shares, and you slowly pay it to build credit. I think that's how you do it. And then somewhere along the lines, when I was 17, 18, 19 to 25, it went downhill. But you got to knock out the debt, Rex.
Yeah, you're part of the masses.
Yeah,
right?
yeah.
I mean, you're not.
So you're saying I'm not the only one?
You're not the only one. So we definitely want to get debt knocked down.
Yeah.
And again, there's some better debt than others, which would be a house or things like that you're needed. Some student loan debt, right, for certain instances and certain career paths, certain income streams. But for the most part, we want to knock down debt. One of the questions we get often is I received this bonus, or I received this inheritance, or I sold an asset and I came into this lump sum. Should I pay down all of my debt? And the answer typically is yes to most of the unsecured debt, credit card debts, things like that. We want to get all that paid down. And then we start looking at interest rates and saying, okay, maybe you have a home equity line of credit that might be at 10%. Well, if you pay that down, then you're immediately saving yourself 10% in interest. Whereas if you put that in the market, you have a risky 10% potential. And so we start looking at the give and take and the pros and cons of those things. We also look at personal habits, as far as do you have the proclivity to continue to save, or if we pay down this debt, when I come back and meet with you in a year, it's just going to be racked right back up, because that's your habits and that's the way that you run your financials. Because we don't want to enable that bad habit by taking this lump sum, all of a sudden paying down all of that debt. And now a year later, now we don't have the lump sum and all of the debt has come back, right? And so we don't want that to happen either.
Yeah. Brandon, how much debt should we take on when we need to take on debt? What's some of the numbers behind that?
Yeah, I think that's highly dependent on each individual situation. As has been mentioned, right? Debt for a home usually makes a ton of sense. Potentially student loans, depending on what career path is. And, can you get by without it? If you can, I mean, that really pays off, But student loans, sometimes vehicles, personally, for me, it's more of a numbers game. And I want to look at it and say, all right, what are my interest rates versus, am I always in a place that I could pay off my debts, that it's easy to handle the debt load? And then from there, also, what is the interest rate and what is my opportunity cost? And so I think when you're looking at this, right, and this is going back to the order, right, let's make sure our insurances are in place. Let's make sure our emergency fund is in place. And then let's look at debt. And really, ideally, let's get down to where we just have a home mortgage, right? Maybe some cars. And that's the healthiest place to be. And so if we are drowning in debt, we really need to focus here before we move on to some of the next things like investments and retirement planning. We need to get the debt in control. I say that with some hesitation because I've had a handful of clients who are just horrendous at debt, right? Who have to, no matter what we do, no matter how hard we try, the debt always gets run up again. And so then you have to make that decision of, okay, ideally we'd pay off our debt and then start investing. But if we wait to do that, we will never pay off the debt and we'll never start investing, and then we'll be in poverty in retirement.
Yeah, I was just going to bring up a scenario. Would you ever suggest someone stop contributing to like a 401k to get rid of a credit card debt for a period of time? But you're saying maybe it's like, actually, they're so bad, they're going to have the debt. Let's get the 401k taken care of and see what happens.
Maybe,
yeah.
Right? And it just depends. It depends, because ideally the reason we don't want to start investing before we take care of the debt is because if we've got a debt issue, that usually means we're over leveraging. And if we're over leveraged and a car breaks down, a furnace goes out, a roof needs replacing, some major thing, and we don't have any bandwidth to fix it, well, now all of a sudden we're trying to pull from the 401k. Yeah. And now we just put money in, but we have to pull it out and take a penalty and pay extra taxes. And it just doesn't make sense to do that. And so, the ideal is to pay off debt, get yourself in a good place so you're solvent, and then start saving, for retirement. But sometimes that's just not, the ideal doesn't work, and we can work around that.
You have to be brutally honest with yourself when you're looking at these things, and what is your personality, because you have to change habits, and that's very difficult, especially later in life. It's really hard to change those habits. And so as you look at yourself and you're saying, okay, if I pay this down, am I really not going to rack it back up? And if you can't answer yes to that confidently, then we have to look at other options. I mean, on the 401k question, we certainly want to capture, the match, because that's an automatic increase from the employer. So we certainly want to capture that. But above and beyond that, should we be doing more than that? Well, we need to hit your other goals, but we also need to get the debt paid down so that we don't have this anchor again on our finances. It's interesting at how good we are at creating alibis and excuses for ourselves. I won't rack it up, this time because I received a lump sum and it just won't happen. Well, the reality is that, your habits tell a different story. And it's too frequent with that type of personality where we'll meet with them again in a quarter or in 6 months, and we just start to see, cracks in the dam, to where all of a sudden, they'd paid down maybe $30,000 in credit card debt or $50,000 in credit card debt, and now we've got $3,000 back. Then the next quarter we're at $5,000 back, and it just starts creeping. And it's like, oh, but I had to replace my tires on my car. And do you not want me to replace my tires? We were down to the bear trap. No, I want you to replace your tires, but I want to make sure that emergency fund is in place, because that's where we should be leaning on instead of a credit card that's charging you 30%. And so we need to change the habits at the same time that we're going down this checklist.
I edited and I'm released. I think I scheduled this Through the Pines short. If you're not following us on Instagram or YouTube, follow Through the Pines on Instagram, YouTube, Facebook. And it's Rex talking about how he does not believe in paying for his kids' school. So has anyone in your family made a payment to a student loan?
I do. I have one child that took out about $3,000-ish. Yeah. On a student loan.
That's not very much. Yeah.
And,
that was a bad quarter or whatever.
Yep. Yep, and that got corrected right quick.
Okay. Okay. But you're not anti-student loans. They're just in your family, kind of, but not in general.
Yeah, just I mean, in general, it's not that I'm anti-student loans. Again, if you're pursuing a career where the starting salary might be $200,000 a year, and it's going to take you 6 or 8 years to get there, and it's such a rigorous program to where you have a hard time taking on a job and working through and paying cash along that way, then certainly if your starting salary is going to be 200, certainly I can understand taking out $100,000 of debt or $200,000 of debt to get that degree, to get into that position. So I can see that. The problem that I have with student debt is when you're taking out $100,000 of debt or $200,000 of debt, and the starting salary is $45,000.
Yeah.
Right? Or you're a lifetime student, which we'd always joke about it in college, right? Because we see these.
Personally love to be a lifetime. If someone pay me to be a lifetime student, that would be rad.
Then they're paying them with student loans, right? And so they're getting almost 3 to 4 or 5 degrees. And I say almost because they never quite get the degree. They're like 2 credits shy of that degree, and then they go after another degree. And so, I mean, that's a problem.
Yeah. All right. So with our ultimate financial checklist, we have insurance covered first, emergency fund, and then knocking down debt. Next up, estate planning. Brandon, what do we need to know?
Yeah, and technically it's hard. Estate planning is one of those ones that technically probably should be done up front as well. We see a lot of people hold off until later in life to do that. I always say, and this is my non-professional opinion as far as I'm not an estate planning attorney, but there's really, in my mind, 2 groups of people that really, really need estate planning. One, someone who's late in life and likely to pass away in the next 10, 20 years. And at that point, it's just, why would you not do an estate plan? Because your kids are going to pay that much in probate, right? Just to try and get the everything settled. So an estate plan is almost a no-brainer. And then the second is young families with kids, right? Because the last thing you want to do is pass away, and then all of a sudden your entire net worth plus life insurance policies all get stacked together into this huge sum of money that just becomes the kids, and when they come of age. And that should be a very scary idea for most people. And so really those are the two. Does everybody need estate planning? Pretty much, yeah. But those 2 groups are really, really important that we get estate planning done. Let
me clarify. Everybody has an estate plan.
That's true.
You just may not like what the state has for your plan.
Yeah,
and so, right. But everybody has an estate plan. Either you get to decide what that looks like, or the state and the feds get to decide what that looks like. And so that's the question: is
how
do you want
much
control
do you
of that
trust
or not?
the state and the feds?
Well, it's not a nefarious plan, right? I mean, the state plan
they try to do well by the family.
They absolutely do. The issue though is there's, because it's so general, there's not like direct guidance, and so you have assets. You're like, well, who does this go to? And then you get the fighting, right? And so because you get multiple people saying, well, I think this, then you bring in a judge, and it's a probate and every, right? Like that is what makes it difficult. It's not that it's nefarious. It's not that the state's trying to take your stuff away. It's just that, like, if you don't legally put in writing how that needs to go and legally put the ownership so that it can flow that way, you're going to have issues, and those issues take time. Sometimes there's fighting, which costs money, and it's a lot smoother if you can just dictate it.
They won't do as good of a job as you, right? Their plan is that your 3-year-old child gets their money when they turn 18, right? That's the plan. And if you think that that's the best solution, if you have $1 million life insurance policy and you and your spouse pass away in the same accident, that your 18-year-old comes in to inherit $1 million, right? I'm not confident, in my opinion, that is the best plan. The other part of the state's plan is that the state will decide who gets to oversee those funds, right? And so sometimes it might be spending Susie that that gets to oversee the money,
right? And
she may feel like, every little whim that you have needs to be funded, such as that Ferrari when you turn 16. And so it may not, be used in the same manner that you would choose for your kids.
Yeah.
So I think it is important. And yeah, everybody does have a plan. Just, do you want to pick what it is, or do you want someone to pick for you?
Spending, what was her name? Spending Sally?
Susie.
Spending
Spending
Susie.
Susie.
Like reckless Ralph.
Yeah, Reckless Ralph. I'm glad you didn't go with Reckless Rex.
No, okay.
So,
I can't because you've proven otherwise, Rex. Oh, okay. Anything else on wills and trusts? And we have a couple podcasts on those. So
we have some great podcasts on estate planning, wills and trusts that you should go listen to.
All right, next up on the ultimate financial checklist. Again, this is a broad overview, so in order, this should be what you take care of. We covered insurance, emergency fund, debt, estate planning, and now it's the savings strategies. Now we get into some of the fun stuff. Rex, what are savings strategies?
Exactly what it sounds like. We're saving, right? And so this is the fun part. This is the part that we enjoy a lot, is putting together your investment portfolios and which areas do we save in? Do we save in the 401k? Do we use Roths? Do we use traditionals? Are we doing non-retirement accounts? Are we using custodial accounts for kids? All these different things. And so looking at not only the types of accounts, but also the amounts of money that we need to save towards different goals. Mm-hmm. How much needs to be allocated towards retirement? How much can we spend and enjoy today? Are we trying to save so we pay cash for that next vehicle instead of taking out a vehicle loan? And so we want to kind of map all of that out so that we're allocating our savings towards those goals.
Yeah, right off. And I think there's kind of two phases of this. Phase one is a lot of times jobs give you some really sweet benefits. Right? A 401k match is a really sweet benefit where you might save 5% of your income and your employer comes and says, here's another 5% I'll give you just if you save it. Mm-hmm. Right? That's an overnight 100% rate of return on your money, risk-free. Right? I mean, that's, and we should never say risk-free, but essentially, right, you're not taking any market risk. The employer's just depositing it in your account and doubling your money overnight, right? Usually that takes, 7 years plus, right, to double that. And so that, a 401k match is a really good one. Sometimes people have HSA matches, which is a health savings account, which is primarily for health insurance type or health related expenses. The other thing, though, even if your employer doesn't have a match, it's the only account you get a tax deduction for up front. Then you get tax-deferred growth. Once you build it up, you can start investing inside that HSA. And then you can have tax-free distributions if they qualify for those medical things, which a lot qualifies. You've got chiropractic, you've got dental, you've got vision, you've got your regular doctor. There's all sorts of expenses that will qualify on that. And so the HSA plan's a great place to look at saving. You've got employer stock plans. And so there's a wide variety of different stock plans. A lot of times employers, if they have like a publicly traded stock, they'll let you buy their stock at a discount. That could be really opportunistic. There's different stock plans where the employer will gift stock, right? And so every plan is different. And so it's important to look at those and say, all right, what are my options? Am I taking advantage of this? Because there's a lot of people. Speaking as an advisor on 401k plans, there are so many people who have the opportunity to double their money overnight, and they're just not taking it. And that's crazy to me. Mm-hmm. And the 401k might be an easier one, but some of these there's stock option plans. There's all sorts of different plans within those NSOs, ISOs, ESOPs, all these different plans. It's important that you understand how those work and make sure you're efficiently utilizing those. And that's where a financial advisor probably makes a lot of sense. Yeah.
Rex, as a percentage of income, is there a number that we should be putting away in savings?
So we like to use the 10 to 15% as a rule of thumb. I used to say 10% of savings will get you a good retirement. If you start young enough, 15% gets you an amazing retirement. Mm-hmm. But a lot of it depends on when you're starting, right? If all of a sudden you haven't saved anything and you're starting at 62, is 15% enough?
You're like 105. Can I do 105?
Right.
Yeah.
What do I hear? 110? I mean, what percentage do I hear?
Yeah.
Here? And so a lot of it depends on, the earlier you start, then we can start with a lower percentage. Typically, because we have a lot of compounding years to catch up with that. But I think setting the habits early is just as important as setting the amount early. And so we try to get those that are starting with their first jobs, whether they're 18 or 20 or wherever that is, and the first time they're qualifying for the 401k, we try to instill that habit before they get a bunch of bills and a bunch of financial responsibilities to start at that 10 to 15%. Because once you start it, then you're building your regular spending and lifestyle habits, assuming that that's already gone. And so then we're not having to make that adjustment later on in life. If you didn't do that, not that anybody wouldn't do that, but if you didn't do that, then typically what we do is we try and get you to start with at least maxing out the company match, pushing yourself just a little bit beyond your normal comfort zone. And so, let's say you're comfortable at contributing 6% into a 401k plan. We might push you to start at 7%. Because we can typically back that back down to 6 if we have to. Mm-hmm. And so we kind of start there, and then on either an annual basis or every time you get a wage increase, we try and get you to increase that from 7 to 8 to 9 to 10 until we get you up to the level that we need you to be at.
And so that is a perfect way. I think that encapsulates, right, that segment of, hey, what are our options? How do we make sure we're efficiently taking advantage of those? Is that what you described, a retirement plan? Absolutely not, right? We have no idea how much we're spending. We have no idea of Social Security. We have no idea if we were saving enough. But a lot of times we just have to start somewhere. And that somewhere is, how much can I do to make sure I'm getting my full match, and maybe I can get a couple percent above it and grow it. Mm-hmm. But then beyond that, once we get that, because there's so many times we meet with people like, man, I'm just not making it, right? Like I don't want to be dumb. I want to take advantage of what's there. But let's just start somewhere. And that is so smart, to just start somewhere. But then eventually, and as soon as we can, we get into the next topic, which is your retirement plan on track? Mm-hmm. And the earlier you can switch from survival of like, hey, I'm just going to get my match, I got my insurances in place, I got my emergency fund, I'm managing debt, that transition is almost like a peak, right? As soon as you get from like survival into retirement planning and long-term planning, there's a mental shift, right? Where you say, all right, like I'm actually like I'm going from survival to fruition and making it and planning for the future. And so these last 3 points are more in that phase of like, all right, how do we, now that we've made it, how do we kind of critique, or not critique, but how do we tune it?
Tune it in.
And that is when the fun begins.
Yeah.
Right there.
It is. Yeah.
But we're going to have to hold off on the fun because we need some more numbers, Brandon.
Oh, man. What a cliffhanger.
Cliffhanger.
Yeah.
Well.
And I have a really good question for Rex, too, that he's going to love.
So excited.
So there's been a lot of talk lately about government shutdowns, right? And is the government going to shut down? And it's starting to become maybe a little bit.
And by the time this comes out, we'll have our answer. So we'll have or it wouldn't have.
And I doubt it's our last one, right?
Yeah, that's true.
And so I think it's worth maybe kind of talking about high level. And that is over since 1996, so last 30 years, we've had 4 government shutdowns. And inevitably, when people start talking about a government shutdown, people come to us and like, oh my gosh, what is the stock market doing? What should we do? How do we avoid this? What's interesting, and this is a correlation, but just because it's been correlated once doesn't mean it'll, correlate in the future. But in the past, we've actually seen positive rates of return in the stock market during government shutdowns. Kind of interesting. 1996, there was a 5-day shutdown. Stock market, S&P 500 was up 1.3%.
In the 5 days.
In those 5 days. Later in 1996, there was a 21-day shutdown. Market was up 0.2%.
So the economy doesn't shut down.
So,
right.
Well, pieces of it, right?
The government does.
Parts
right,
of the
which can shut down. So I read an interesting article earlier on government shutdowns, and there's been 3 since the year 2004, since 96, right, as far as government shutdowns. The last 3, when they looked at it, it essentially impacted the U.S. economy by pulling out about $8 billion out of the GDP, out of our gross domestic
product. Sounds like a lot, yeah.
Right? And then once the shutdown was over, typically what happens is the government then goes and pays everybody their salaries that they were supposed to get during the government shutdown, and kind of makes most people whole, but not everybody, because some of the businesses that they were doing business with, that business is never made up. And so on those shutdowns, on average, it was about $3 billion that never went back into the economy during a government shutdown. So it can slow the pace of growth of the economy, which even though during the shutdown it may not drastically impact the stock market directly, it may have a longer term slowing impact during the following 3, 6, 9, 12-month period until the economy kind of gets rolling again.
Which is like darn near impossible to measure, really.
But that money never gets back into the economy, that $3 billion, whatever that savings. And so it'll be interesting this time. And again, by the time you're listening to this podcast, you'll find out if we're right or wrong, right? And so it'll be interesting this time to find out, because the current administration has been on a big push to cut government spending and to cut government employment, to reduce government employment. And so it'll be interesting to see if they utilize this government shutdown to not bring back certain employees that are on furlough, or to try and turn it so that they're not receiving all of that back pay during that government shutdown to create additional government spending savings, if you will.
Okay.
It's also important to point out the stock market usually is going up, so it's not really a surprising statistic. However, this is not a big case, right? Like 4 sections of the economy, right, for a couple periods over history. That's not a big sample set, so it's very easily you could very easily see a negative market.
Yeah.
But I think what this points out, though, is that it's not like a sure, when government shutdowns happen, it's not like a sure thing, like, oh my gosh, the world's going to end.
So if you have money invested in the market and the government shuts down, it historically is not a reason for panic.
Yeah, I mean, normally if you have money in the market, that should be your long-term money, right?
Yeah.
And again, you're buying companies, right? You're buying, the lumber yard, you're buying the retail store, you're buying the coffee shop, whatever it is, right? And so if that's a good, strong, steady business, that's going to continue and to be a good, strong business. So they may have a bad quarter, they may have a bad year on occasions, but again, you're typically not investing in the stock market for a quarter or for a year. And so those volatility periods should actually provide opportunities for you to buy more of some great companies. And again, you may have to wait 6 months, a year, 2 years, 3 years for that, to be recognized as far as the growth on that. But that's what you're investing in, is you're buying equity, you're buying companies that over time should generate significant more revenue.
Brandon, let's talk retirement.
All right.
What you
Retirement's good.
I didn't know you retired.
Yeah, it's such a good cliffhanger. I was excited for the question. But no, yeah, I think so. Once we've gotten all the other essentials in place, then we really want to start talking retirement. And the starting point for me is to figure out where are you at right now with your expenses. Most people don't really have a good answer for that. If you ask them how much do you need for retirement, they're like, I don't know. Right? We've got so many expenses now that I think will be gone later, and taxes, and there's so many variables. It's really hard to calculate that. For sure, it's not just based off your gross income, right? Because you've got savings, you've got taxes, you've got Social Security taxes, Medicare. I mean, there's a lot of things that change. And so what we like to do is kind of separate those things out, and Rex and I will walk people through that to separate those out and say, all right, here's really what your monthly spending need is. And then we project that into retirement, adjusting for inflation, and say, all right, how do we hit that goal? And kind of initially, for me, it's how do we take where you're currently at and make sure that's sustainable for the rest of your life? That's the baseline, right? Now, there's a lot of other things where people are like, well, actually, I think I'd like to start traveling more. And I think those are fantastic goals. But we get the baseline in place. Let's make sure you're sustainable. And then we go into goals above and beyond that.
I think people, Rex, correct me if I'm wrong, may be surprised in two opposite ways. One, how close or how near they actually could be to retirement.
Yeah.
And then two, how much it might cost to retire.
Yeah, I think people are surprised by both.
Yeah.
Right? I think very frequently they're surprised how close they are to being able to retire on their terms and when they want and how they want. And two, I think they typically are surprised at what the dollar level or asset level is that they need to be at by retirement, because it feels daunting, right? When you're 40 years old or 50 years old and you might have, $500,000 saved up or $1 million saved up for retirement. And when we're looking at the spending, we're looking at the long-term target, and we're saying, hey, look, we really need to target maybe 5 million by retirement. And just that's a shock factor that they sit back and say, oh my gosh, I'm never going to get there. And that's so much money. I don't need that much. These guys don't know what they're talking about. And I assure you, we do know what we're talking about.
Wait, do you do this for a living, Rex?
I do this for a living. I know what I'm talking about. If you're 50,
and for a long time.
well, we should have 3 doubling periods, right, before retirement, roughly, or 2 or 3. And so the million turns to 2, turns to 4. Plus you have your additional savings that you're saving from 50 to 65 or 67, whatever that time period is. And that's also going to grow. And so when you start looking at it and breaking it down, it's very reasonable to look at. It's interesting. One of the things that Warren Buffett would frequently talk about is that, the curve on your savings is very flat for the first 10, 15, 20 years. And then as the compounding really starts to take effect, it really is the long game, and it really comes into play down the road. Those last 2 or 3 doubling periods are significant when it comes into play.
But we can give you the steps today that are a lot more simple to look at and digest and say, all right, this is just let's save this into the 401k. Let's do this with the IRAs. And if we do these things, we hit this assumed rate of return, we'll be here. And that makes it so much easier.
I think it's, one of the things I've heard a lot lately over the last year or two is people have started, there's this thought process going around, and sometimes it's online, things like that I'm hearing, to where people are taking the attitude a little bit of, wow, I really want to save differently for 3 different periods of retirement. I've got they're calling it their go-go years, their slow-go years, and their no-go years.
That's
right?
hilarious, by the way.
Right?
So funny.
Right?
Yeah.
And so, and it's
brilliant. Okay.
such a fallacy. It's not, I mean, the marketing of that
It's
is
cute.
brilliant.
Marketing's
It's very
awesome.
The marketing is brilliant, right?
Right.
Because it's memorable, it'll stay with you.
Yep.
It resonates with people. Oh yeah, when I'm 65 and I retire, I want to travel, I want to do all the things, I want to spoil my grandkids, and then I'll probably go through a slower period when I hit 75 or 80, and then when I hit 85 to 90, I really don't want to do anything. But the reality is that it's just a trade-off of expenses, right? We're trading all of a sudden those travel expenses for dental care, right? And so just the other day, we had somebody reach out to us that had like $40,000 in dental expenses, right? Because Medicare doesn't cover dental.
Right.
And so it's a massive expense that typically doesn't hit you until you're into your 80s or even 90s. And so and then maybe in-home care or long-term care, somebody that's going to help out on those different things. And so, I think don't get swayed or fooled by whatever the latest trendy marketing planning tool is out there that's going to try and sway you away from just good common sense planning, which is what we want you to do.
I just had to look up because I saw this post the other day. Dick Van Dyke, 99 years old, just got busted in the gym working out.
I saw a picture of that.
Yeah.
That was awesome.
Yeah. By a famous musician who was in his late 70s. And he's like, I thought I was doing good. And here's Dick Van Dyke working out on like every machine in the gym during his no-go years.
Yeah, I mean, hat off to my dad who's 93 and still is going to the gym 2 or 3 times a day.
Oh, hell yeah.
That's
That's awesome.
And so, I mean, just stay active, people.
Okay, so here's the question I had for Rex that I think, Brandon, I'm hoping you'll fight him on. Rex,
All right.
All right.
Can you save too much money, Rex?
No.
The low balls.
No,
Too
you can't save too much.
You can
No,
absolutely
you
save too
can't.
much.
It depends on what your goals are, right? And so it depends on,
So you might be able to save too much money depending on what your goals are.
I guess, if you don't want to create a legacy and pass it on to future generations and things. It depends on, like, I have a goal to create a legacy and things like that with my family and the communities that we live, things like that. And so can I do too much towards that? No, I can't do too much towards that. There's a lot of needs out there in the world today, and I want to make a difference, not only in my family and their families, but also in the communities where I live and the communities that I care for. And so can I save too much money? The answer to me is no.
And I think if that's your goal, I think you're absolutely right.
Say that one more time.
If
I'm right.
If that is your goal, I think that's absolutely right. However, most times that's not people's goal. There's a lot of people that
Dream bigger.
No.
Well, I think let me speak for you for a minute, Brandon, and that is, and I think Rex is doing this. Rex, hopefully, you're making enough that you're not sacrificing living and vacations while saving for that. Correct?
Depends on who you ask.
Oh snap! Okay.
Let me. Okay.
You ask my wife, maybe.
Okay.
So
Now we're in trouble.
let me just share a story of myself. We were in college, no money, right? We had Ruby on the way pretty early on, and my wife was like, "We need to do a baby moon, right? We need to go down to Zion's, which is a national park close to us. We're just gonna go down. I think we stayed there one night, right? And we're just gonna drive down, do some hikes." And I was just like, no, like we need to save money, right? I was on Rex's team, like you could never save too much money. We've got all the unknowns of the baby, right? And anyway, she convinced me, and so we went. And I'm sure we spent no more than probably $300 between gas, the hotel room, and we ate snacks for food, right? Like it was on a budget. But I look back on that, and do I wish that I would have saved that? Not a chance.
Mm-hmm.
Like I am so glad I spent
have the memories.
that. So glad I spent that. It was responsible. We still had our emergency fund, but I'm so glad we made those memories and didn't just plow it into savings. And I've since that time, and I always think about that, but since that time there have been multiple times where I have not wanted to spend. I was like, man, if we just don't spend, they could build up our savings. And I've looked back and said, I am so glad we did. Like, so glad we did. And so that would be my answer to, can you save too much? Absolutely. Because I've watched plenty of clients who weren't comfortable, didn't understand their retirement plan, and out of fear, didn't spend and saved extra money. And I think that was a mistake.
Yeah, I think if it's out of fear, I think that's a poor place to be saving out of.
Yeah.
Right. Yeah. And I agree with you. There's a balance between living for today and saving for tomorrow.
Yeah.
There's absolutely a balance on that. That being said, I think too frequently people are overweighting the living for today versus saving for tomorrow.
There seems
As
to be
you
a
said,
trend.
it's too easy to make the excuse and to do the thing. So I love having the differing perspectives here on this. And I think it's valuable for our listeners. So thanks very much, both of you, for being different, I guess, which is
You got it.
which is good. All right. Anything else, Brandon, before we break out of here? You had other major financial goals, but they kind of wrap into the savings part.
Yeah. I would just follow up with, after we get your retirement on track, then a lot of times kids' education funding, and it doesn't need to be education, but it can be other savings goals for kids. I think that's important that that's after your retirement plan is in place. I frequently get people that are like, I want to get my kids' savings going. And I was like, well, but you're not ready yet, and you can get your kids through college, but to anticipate them to take care of you during retirement, that's a bad assumption, right? Like that creates angry in-laws. And so I would say, get your own retirement on track. Then, if you want to, you don't have to, but if you want to, then look at kids and grandkids savings. And then beyond that, then it's the other major dream things, right? Boats, cabins, vacations, family foundations,
Generational wealth.
right? All of those things.
Yeah, I think once you get through this checklist down to your retirement plan, I completely agree with what Brandon just said, that at that point, you need to go through a priority of your dreaming, right? Are we trying to cover kids' college? Are we trying to pay for weddings? Are we trying to buy a second home? Are we trying to create a legacy or generational wealth? What is it that's important to you? And it's going to be different for every family. Just because I have a certain dream doesn't mean that that's Brandon's dream or the other Brandon's dream. That every family is going to be very different there. And it's our role to listen to you and to listen extremely well and to try and help guide you down the path that you want to go with those goals.
Oh man, I wish I could recall quotes better.
Well said.
And this is not new information because I read Meditations, the book by Marcus Aurelius.
Oh, Marcus Aurelius.
And he's got a line in there, so I'm pretty sure it was it, and it was back on living, and it was about appreciating what you have today and taking those taking those chances to live for today while not forgetting the important stuff in the end. And you can't do that either. You have to have.
And that hasn't changed in the last 2,000 years,
right?
Yeah. I mean, that's still the same story.
Same story.
And we're still making the same mistakes, people.
Yeah. All right. Well, thanks for listening. We'll end on same mistakes, people. You got to get your together. This podcast was produced by the Brandyn Collective, recorded in our camp trailer here, the studio located inside the Monarch Building in the Nine Rose Arts District on historic 25th Street. And if you found value in this podcast, which I know you did, you should consider supporting us at buymeacoffee.com/Banyan Media, where I will just tell you, just give us all of your retirement. And that goes against everything Rex and Brandyn just said. You can watch, I'm kidding, but you can donate like $5 or something. And it'd be great. Watch and subscribe to us on YouTube at Through the Pines, like our Facebook page at Pines Podcast and our Instagram page at Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.